All right, good morning, everyone. Once again, my name is William Echevarria. Today, we're going to be talking about asymmetric investment strategies, okay? And for those of you that don't know, my name again is William Echevarria. I am an educator, I'm an investor, and now I am also a visionary with outside and critical thinking solutions, okay? So for today, we're going to add onto the previous concepts that we've had earlier on in the course. Okay, so as we've gone through, you learned the power of 72, you learned the ROIs, the single digits, and last week we were doing double-digit ROIs. And we saw the 7 tips of investing in real estate. So today, we're gonna learn about triple-digit ROIs. Okay, so what we're gonna do is we're gonna learn from the individuals who are already doing this. It's the best teacher. Instead of trying to reinvent the wheel, look at what somebody successful is already doing and model after them. So right now, if you look at it, between all the richest individuals that we have in the world, we have the Jeff Bezos of the world, we have the Elon Musk of the world, we have the Bill Gates, and now I want to share with you a video that Jeff Bezos put out a couple years ago. And then I'm going to ask anyone who's in the room what their thoughts are on that, and then elaborate a little bit on that. So right now, let me go ahead and share my screen. I want to show you my presentation, and we're going to go from there. So if you guys don't mind actually telling me when you can see the screen, and we can go from there.
Yes, we can see it.
Awesome. Okay, so let's get into it. Give it a second.
To become overly cautious, kind of failure averse, and therefore unable to invent and pioneer. You cannot invent and pioneer if you cannot accept failure. To invent, you need to experiment. And if you know in advance that it's going to work, it is not an experiment. And so that's a very important thing. They're inseparable twins, failure and invention. So you have to be willing to do that. And it's embarrassing to fail. It's always embarrassing to fail, but you have to say, no, that's not how this works. If I said to you, you have a 10% chance with a particular decision, a 10% chance of a 100x return, you should take that bet every time, but you're still going to be wrong 9 out of 10 times. And it's going to feel bad 9 out of 10 times. And with technology, the outcomes, the results can be very long-tailed. The payoff can be very asymmetric, which is why you should do so much experimentation. Everybody knows that if you swing for the fences, you hit more home runs, but you also strike out more. But with baseball, that analogy doesn't go far enough, because with baseball, no matter how well you connect with the ball, you can only get 4 runs. The success is capped at 4 runs. But in business, every once in a while, you step up to the plate, and you hit the ball so hard, you get 1,000 runs. And so when you have that kind of asymmetric payoff, and one at bat can get you 1,000 runs, it encourages you to experiment more. It's the right business decision to experiment more. It's also better for your customers. Customers like the successful experiments. By the way, this is a giant misconception in a lot of young entrepreneurs, inexperienced entrepreneurs that they meet. One of the things that is very fashionable right now is to talk about how disruptive their business plan is going to be. And but invention is not disruptive. Only customer adoption is disruptive. At Amazon, we've invented a lot of things that customers did not care about at all. And believe me, they were not disruptive to anyone. So it's only when customers like the new way that anything becomes disruptive. And so really, it's just saying that you want to, if somebody comes to you with a business plan that they claim is disruptive, you should ask them to explain it to you in simpler language. And the simpler language is, why are customers going to adopt this? Why are they going to like it? Why is it better than the traditional way?
So along those lines, we have some press and media in the room. Is there something that you think people get wrong about Amazon that's
So with that, guys, I wanted to open up the floor real quick. If you are brave enough to jump online and give me what you thought that message was about. What did you think of what Jeff Bezos said? And I was listening to this one more time. I remember a conversation with, well, I didn't have the conversation, but a conversation that I saw Mark Cuban have, which was the same thing. He was like, you can take 1,000 at bats, but you only have to be right that one time. This goes with the same concept of asymmetric risk, right? So the same way that Jeff Bezos was talking about, if you take 10 at bats, 9 out of 10 times you're going to lose, but all you have to do is win that one time. So I wanted to hear from you guys, what did you think about that? And then I wanted to open up the floor and give my explanation of that and what my mentor has been teaching me as well. So Katya, you put in the chat the take risk, and you never know which one will work. Exactly. Anybody else have anything different or anything else they would like to add to that? Lyndon, your mic's on. Are you trying to say something?
No. let me cut it out here real quick.
Okay,
No
okay.
worries.
Yeah, no
I
worries.
guess I can speak on what the message tells me, and it's just kind of to diversify your investments, right? Your opportunities. So, not putting all eggs in one basket. So if you diversify your opportunities, there's one or two that could, there's a bunch that could fail. However, that one or two wins may take over the entire portfolio that we already have. So
Yeah, you're absolutely correct. Yep, you're absolutely right. Let me go ahead and show you the next screen so that you can actually get some visual, also context to go along with it. All right, so just like Jeannie had mentioned, okay, with the concept of asymmetric risk, here's a scenario that I want you guys to envision, and hopefully this diagram will depict that. All right, so say that you have $15,000 of capital that you want to invest in something. So instead of putting all your eggs in one basket, you definitely diversify. So now let's say that there's 15 opportunities that you have done your research on. Okay, you've done your due diligence, you have that good feeling about it. You're not just going off of pure emotion, like you've done some analysis. You feel good about these. And again, these are long shots. This is not a short-term strategy by any means. This is not a day trading opportunity or a swing trading. This is not something where you're going to be watching the market every day and freaking out because it's going up and down and sideways and every which way. This is something that you're going to set, you're going to forget about it, and then one day you're going to look at your portfolio and then just out of nowhere, like Jeff Bezos said, you're going to hit 1,000 points. So when you look at this, right, you put equally $1,000 into 15 different companies, okay? What he's explaining by this is you're going to lose more than you're going to win on this strategy, but it's asymmetric. All you need is for 1, 2, or 3 in this example to actually win. And those that win, they're going to win so much that they're going to completely wipe out all the losses that you had and then some. Okay? So if you look at that, let's put some numbers to that so you can see it a little bit more. Maybe if PowerPoint wants to work, but here we go. All right. So like I had mentioned before, you have 15 investments that you do your due diligence on. Okay? You put $1,000 in each investment and you set it and you forget it. Okay. Now, in this scenario, the results are 12 of those investments fail and 3 of them win. But those 3 win so big that each one of those, they basically got $100,000 from your $1,000 investment. Okay, so between all 3 of those right there, look how much you're winning. It completely offset the $13,000 that you would, well, $12,000 that you would have lost, because now your earnings are $300,000. That's a 2,000% total ROI. Okay. And now when we do the ROI, we start breaking that down into your yearly ROI. And what does that look like? Well, you do 2,000 divided by 5 years, which was the period. You got a 400% yearly ROI. There is an example of a triple-digit ROI. Okay. And like I mentioned, this is a long-term strategy. Okay. Now, the way that you have to do that, and I want to put some more context into that, how do you identify what that could be? Okay. And on this next slide, what you want to do, and especially now in the recession, I want you guys to go out there and definitely be open and open your ears and your eyes to what's happening. Okay. With this recession, there's going to be a lot of opportunity. Okay. Don't only look at the negative side of this. There's going to be a silver lining to this. Somebody's going to come out with some kind of a creative solution. Somebody's going to come out with something completely different, something radical, something that's going to disrupt the market, right? So when you start listening to some of these opportunities, think about what some of these companies did in the past. Okay, Tesla disrupted the whole automobile industry with coming up with electric vehicles. That's a complete game changer. In the beginning, though, if you look at Tesla's like financials, Tesla looked horrible. Like they were up, a mountain basically fighting all these titans and giants in the automobile industry. You wouldn't even bet that, but that was a disruptor. And look what Tesla stock is looking like today. Uber disrupted the taxi game, right? Everybody else who has taxis, no matter where you're at, New York or a busy city, Uber now has basically disrupted that. And you see that now that's a different source of income. People can have more taxi drivers than waiting around for, the yellow cab. Apple, we don't need really to explain what Apple has done. Apple has disrupted the market in so many different ways, from their products to their ecosystem to their culture. Like, these are the game changers. And if you invested in them beginning because you believe in the technology and you believe what the vision is, that is your moonshot. Okay, you push a little bit of money into it and you literally forget about this. And you wait until this company actually like turns your investment into a fruitful return of investment. And then now, when you guys are noticing, right, there's a lot of talk about ChatGPT. There's a lot of talk about AI. It's becoming more common, more mainstream media than ever before. So if you really do like the idea of AI, do your due diligence, do your research, find out which technologies you think have the best potential of disrupting things, right? And you go into it. And those of you that are old enough to remember Blockbuster didn't want to actually adapt with the times. When Netflix came on the scene, I don't know how many of you guys remember that, Netflix wasn't streaming first, right? The thing that they did was they were sending DVDs to your house in these little envelopes, right? You can actually rent a couple of them out, you give them back to them, no problem. Blockbuster didn't think that this was actually going to beat their model. Their brick and mortar, they had these new release Tuesdays or whatnot. You will stand in line, you will try to get your movie, you had no movie, and then basically you're just sitting around waiting for people to drop their cassettes, the DVDs or whatnot back down the chute, and you're paying attention to them, right? Blockbuster missed the opportunity, but Netflix was like, okay, we're gonna take it even one step further from that. Then they introduced the whole streaming media, and then look how that caught on fire. How many streaming services do we see nowadays? You have your HBO Maxes, you have your Paramount, you have Disney Plus, you have so many different streaming medias, but who was the pioneer on that? Netflix. And again, you look at Netflix's financials, you look at their stocks, their trends, their trend lines, whatnot, you can see that if you put $1,000 seed money back when they first started and you understood the concept and you believed that this was actually going to be, a game changer and a disruptor in the industry, look how much money you would have been sitting on. You would have definitely hit those 2,000% ROIs. And if you break it down into a yearly example, there's your triple-digit ROIs. Okay. So again, I want to reiterate, because we're coming to the end, this is not a short-term strategy. Okay. This is completely a long-term strategy. The way that you want to do this, you definitely have to do your research. Okay. Look at what's out there. What are the new technologies, whether it's going to help individuals, a certain market, a certain niche, really understand what's happening in that. And if you truly do believe that this has a lot of upside potential, put your money into it, right? Leave it alone. Again, another tip, don't go through a financial planner to figure these things out for you, because they're not doing the due diligence. They're not trying to figure out, they don't have an insight on the market, like a hot pick or kind of like a secret, like a Martha Stewart kind of insider trade. They don't have that, okay? All they want to do is manage your money, get paid on commissions, whatnot. They don't really care about that. Do your own work. Go on online trading platform, take your pick. There's tons of them out there. Invest into it that way. Have ownership of your own portfolio, your own assets, right? From there, definitely commit to the plan. You have to have nerves of steel on this because all of these things are not going to have a hockey stick trend. Okay, there are going to have moments where they're going to dive. There's going to be those early adopters who really believe in it. Then there's going to be that market resentment. So expect that to go down. You know, it's going to be a scary moments for you, but if you truly believe in it, hold on for the ride, because all it takes is that one at bat. And when they hit that out of the park and you have that 1,000 runs automatically, there you go. You're going to be so happy that you stuck with it. Okay, that's that loyalty is going to pay off. Then at the end of it, you're going to keep on looking at your stuff, let's say annually, on an annual basis, right? You see some things that are kind of like, okay, I don't know where this is going, a new direction, so on and so forth. Then you can go ahead and make your adjustments. But I don't want you guys to be looking at your stuff daily, like, oh my God, I lost 20%. Oh my God, I lost 10. I lost 80. I lost almost all of it. I got to pull out. Hold on to it and let it ride. Let it do its thing for a little bit. And I want to finish off with the last one, which is the golden rule of all of this investment stuff is only invest what you're able to afford. Okay, what you're willing to lose, what you can afford to lose. Don't invest the whole house. Don't bet the farm. Don't invest with your mortgage payment or your rental payments or anything like that. If you have a little bit of cash sitting on the side and you're okay with it going up, down, sideways, or whatnot, then put your money into that. Okay, because not everything is a winning solution. But if you don't take a risk, you don't get a reward. All right, guys. So with that, I want to finish off this week's class. If you guys have any questions, you would like to know more, please definitely put some questions, I guess, in the chat. Reach out to me and let's get started, man. Let's get you guys some money. You guys have any questions? Anything you would like to add? No?
Not today. Thanks, Will.
All right, no problem, guys. All right, guys. Well, you have a good weekend, and we'll see you next week.